So we discussed the agency cost of debt in the last lecture. There are three different types of agency costs we covered. The first one is called asset substitution. So basically it means that even if there is a negative NPV project, shareholders, they will actually want to proceed with this project. So this will reduce the firm's value and it will harm debt holders. And this type of asset substitution will lead to overinvestment. And then the second type of agency cost is the debt overhang. In this case, basically, if there is a positive NPV project, however, shareholders will not finance this positive NPV project. So this will lead to underinvestment. And then the third type of agency costs is a more extreme form of debt overhang, that is cashing out. So basically it means shareholders will want to liquidate some fixed assets. Even doing so will reduce the firm's value. And so you can consider this as a very extreme case of debt overhang. Clearly, this section is about understanding. That is, you want to understand why we could have these different types of agency costs. So put some time, read the lecture notes, and think about it. Okay, today we continue with this debt overhang. So in the last lecture we said if there is this probability of default, then there is debt overhang. However, we did not actually measure it. So now we want to find out a measure which helps us to understand how severe debt overhang is in a particular firm. So how do you measure the severity of debt overhang? Well, we could use the following formula here. So let's say, suppose the required investment for a project is I. And then equity holders will only finance this project if the following formula holds, right? So you can see that the formula tells you how severe the debt overhang problem is. Essentially, you can see here, if D is 0 and beta D is 0. So if there's no debt or there is debt but the debt has no systematic risk, then in this case you can see that the left hand is 0. So this basically means that in this case, equity holders will invest as long as this project is a positive NPV project. So this basically implies that if the firm has no debt or the debt is risk-free, then investment is efficient. There is no debt overhang. Now you can see that when you will have this debt overhang problem. So basically, if D is positive and beta D is positive, that is, if the firm is using debt and this debt has systematic risk, in this case, there will be debt overhang. So you can basically see that if this right-hand side is larger, then debt overhang problem in this firm is more severe, right? So basically, you can see that this formula basically says any project with a positive NPV smaller than this right-hand side will not be pursued, right? So if the right-hand side is larger, then more projects will be ignored by shareholders. So the problem of debt overhang is more severe. Okay, now let's look at the following. Let's look at the following problem to understand this formula. So let's say we have two firms, Sears and Saks Fifth Avenue. So, okay, so we have Sears and Saks. And then its equity beta is 1.36 and debt beta is 0.17 and debt equity ratio is 1. And for Saks Fifth Avenue, its equity beta is 1.85 and its debt beta is 0.31 and its debt equity ratio is 1. So now we wanted to estimate the minimum NPV such that a new 100,000 investment will benefit shareholders. So what we can do here is we will use this formula here. So NPV divided by I has to be larger than beta D, D beta E, E. So if we plug in numbers, you can see this would be 0.17, 1.36, which gives us what? Oh, sorry. The debt equity ratio in Sears is actually 0.3. So this is 0.17 divided by 1.36 times 0.3, which gives us 0.375. Now, for the other firm, we require this to hold. So plugging numbers into this formula, we get this is 0.1675. And the problem says the firm has a investment of $100,000. So plugging I equals $100,000, we get NPV larger than 37.5. And for Saks Fifth Avenue, NPV larger than 167.5. So this basically says for Saks Fifth Avenue, if a project has NPV larger than 167.5, then shareholders will finance this project. However, if the NPV is positive, but it's smaller than 167.5, then the shareholders will not finance this project. So in this case, investment is inefficient. That is, if NPV is positive, however, it's smaller than this number, then shareholders won't make the investment or finance this project. So in this case, it's inefficient, right? Because we know that if it's a positive NPV project, the firm should pursue it. Similarly, for Sears, for this firm, if NPV is positive but smaller than 37.5, then it will not pursue this project. Okay, so if we compare these two cases, we can see that Saks Fifth Avenue will have a larger debt overhand problem because this number here is larger, right? So this firm will ignore more positive NPV projects. Okay. So what's the fundamental reason we have this agency cost of debt? Is it really because we have debt? Well, it's not. We have agency cost of debt because there is the probability of default. So it's the probability of default leads to agency costs. And in this case, the equity holders or the shareholders, they will forego positive NPV projects, and they will invest in negative NPV risky project. And if they do this, they will benefit themselves at the expense of debt holders. So you can see that it seems like debt holders will be harmed and equity holders can benefit. But ultimately, debt holders, they understand this. So if they understand this, they will pay less for the debt. This means the firm will raise smaller amount of money, and then shareholders will ultimately bear this agency costs. A very important result is you can see that if the probability of default leads to the cost of debt, then it means that if the firm will never default, then there will be no agency costs of debt. So we can see this result in this example. This example says, would the agency cost of debt described previously arise if the firm had less leverage and owed only 400,000 rather than 1 million. So now the firm has smaller amount of debt. So now let's see whether we will have these asset substitution or debt overhand or cashing out problem. So let's examine this one by one. Okay, first, let's figure out the firm will not have default problem. So you can see that the firm's market value at the end of the year is 0.9. And it has only a debt of it only has a debt of $0.4 million. So the firm will not have any probability of default. Next, let's check whether there will be asset substitution. So we will use this table. What we're gonna do is we will just change some numbers. Okay? So you can see that again, if the firm uses its old strategy, then the value of asset and debt would always be 900,000. If the firm uses the old strategy, then the value of asset would be 900 and debt would be 400 and equity would be 500. So now let's see whether this firm will want to pursue this risky strategy. And we know that if the firm is successful in this new strategy, then its value of asset would be given by this. And if there's a failure, it's $300,000. And now let's see how much debt holders can get. So in this case, in the case of success, debt holders can get 400. So equity holders would get 900. And then in the case of failure, obviously the firm has to declare bankruptcy and debt holders will only get back $300,000. So shareholders will get back 0. And of course, the expected value here would be 800, and then the expected value of debt would be 350. And you can find out the expected value of the equity would be 450. So we would compare these two cases. right? The case of this old strategy and the case of the new risky strategy. What's your result? Well, you can find out the firm's value is higher, right? It's 500 versus 450. So the firm will use the old strategy and will not pursue this risky, inefficient project. So in this case, you can see that there is no asset substitution, right? Okay, now let's examine the debt overhand problem. So now let's see this. So we will use this same $900 and total firm value $900, debt $400, and equity $500. And now we have a new project. So we will use the same number here, and project payoff is the same, 150. Total firm value the same, and debt will be 400. So in this case, you can see that after paying back debt, the equity holders would get back 650, right? So in this case, you can see that the equity holders' value would be larger under this new project. So this implies the equity holders will want to finance this project. I mean, the intuition here is quite easy, right? Basically, now there is no default risk. So the returns or the NPV from this project will be fully captured by these shareholders. So as long as this is a positive NPV project, shareholders will be happy to finance it. Okay, great. Now let's look at cashing out. So you can see here, first, there's no cashing out. So if the shareholders, they don't do this cashing out behavior, then their value would be 900,000. That is the firm's end of year value minus the amount of debt. So their payoff would be $500,000 if they decided to cashing out. Now what would happen is the firm's value would actually decrease by how much? Will decrease by $100,000, and they will get back to 5,000. Still, they have to pay back the debt. So in this case, you can see that the end value for the equity would be I don't know how much. I think it's 4 something. 42500, right? So basically, you can see that shareholders, the value of their equity would be larger if there is no cashing out. So basically, they will not pursue this cashing out. Okay. Now, you might wonder, since there are these agency costs of debt, then what can we do to reduce these agency costs? Right? So there are several ways. The first is the firms can use short-term debt to reduce the agency costs of debt. So basically, you can see that the key here is about short-term, right? Because these debt, they have short maturities. It basically means shareholders, they don't have enough time or they don't have enough opportunities to profit at the expense of debt holders. And of course, there is a cost if the firm only uses short-term debt. So basically, if a firm uses a lot of short-term debt, then it has to repay or refinance its debt more frequently. And continuously obtaining new debt will increase the risk of financial distress and transaction cost. And second, lenders such as banks, they can actually place some restrictions on the actions that the shareholders can take. And you can see that this could be useful, right? Because in the case of asset substitution, we know that shareholders, they will pursue negative NPV risky project, right? In this case, debt holders, they can sign a contract when they are lending money to the firm. They could say, this firm cannot invest in negative NPV project, or any project with this potential to be a negative NPV project has to be verified by representatives from the debt holders. Right? In the case of debt overhand, the shareholders, they will not finance positive NPV project. So maybe when the lenders are signing a contract with these shareholders, they could say, if it's a positive NPV project, then the firm should invest in that project. And then in the case of cashing out, so basically these shareholders, they will sell fixed asset, right? And then they will use the proceeds from the sale of these fixed asset to pay them dividend. So in this case, the debt holders, they can use the debt covenants to tell these shareholders, you cannot pay dividend, or these debt holders can put a cap on the amount of dividends which can be paid to shareholders. So in this case, it will be more difficult for shareholders to do this cashing out strategy, right? Of course, you can see that there is a cost of doing this. The reason is because when the debt holders are signing a contract telling shareholders what you can do and what you cannot do, this will eventually restrict the management team's flexibility. So possibly this will reduce the firm's investment opportunities. Okay, well, we discussed the agency costs of debt. Now, interestingly, we can also discuss the agency benefits of debt, right? So this is very interesting. It basically tells you from the agency perspective, debt can have both costs and benefits. Of course, this makes things more interesting and more complicated, right? It basically means when you're evaluating the financing policy, you have to think about what kind of benefits you get and what kind of costs you get. Then you will do this cost benefit analysis. Okay, so to discuss the agency benefits, we first start with this premise of management entrenchment. So what is management entrenchment? Well, the hypothesis basically says that CEOs are powerful people. They face little threat of being fired and replaced. So they could free to run the firm in their own best interest. So here the keyword here is in their own best interest. Theoretically, CEOs work for shareholders. So CEOs should always maximize shareholder value. However, if shareholders, they can free run the firm in their own best interests, then CEO's best interests can deviate from shareholders' best interests. So you can see that potentially CEOs can benefit themselves at the expense of shareholders. And if you watch news, you can see a lot of things like this, right? You can see a lot of corporate sort of scandals, right? Such as Enron or WeWork or Wirecard. If you watch news, you can see that generally these CEOs made a lot of mistakes, and they would they generally benefit their own interest, and then harmed the shareholders' interests. Okay, so if we maintain this assumption of management entrenchment, we want to understand what's the benefit of debt to reduce this management entrenchment. So there are two main channels. The first channel is leverage will increase ownership concentration. The second is leverage will reduce managers' wasteful investment. First, ownership concentration. So this is actually a very very intuitive argument. Basically, it says that if you use equity, then the ownership concentration will be reduced. So in this case, CEOs they could work less hard, or they could increase their perk consumption. So let's see this example here. This guy, Ross Jackson, is the owner of a firm, and he can finance his new investment by two forms of financing. First, he could issue new shares by selling 50% of the firm or using debt. What you can see here is the ownership structure is different under these two forms of financing. For the first form, 60% ownership will be in the hands of Ross Jackson, the CEO, and 40% will be in the hands of other shareholders. And for the second form of financing, when this owner is using debt, what would happen is Ross Jackson retains 100% of the ownership. So now you will see this very interesting result. That is, if it is using equity, right? Now let's say the firm earns $1. Right? This $1 will be divided by Ross and other shareholders. Right? So essentially, Ross has 60% ownership, so Ross will get $0.6, and other shareholders will get $0.4. Right? Now, this is about value or the gain, right? So if the firm's value increases by $1, Ross will get $0.6. What's the implication of this? It basically means that because Ross will only get 60% of this $1, so potentially he will not work that hard, right? Think about this. Let's think about the other case. That is, Ross is using debt. So in this case, if the firm's value increases by $1, Ross will get $1, right? So if you compare these two scenarios, you can see that Ross should work harder when the firm is using debt, right? Because he gets 100% of the gain. But if the firm is using equity, he only gets 60%, right? Now we're talking about gains. Let's talk about cost. So let's say now the firm wants to buy a $1 million private jet. So this is an expense. This is a cost. Because Ross has only 60% ownership, so he needs to pay $0.6 million. What about the other shareholders? Of course, $0.4 million. Now, in the case of using debt, still we're talking about this $1 million jet. In this case, Ross has 100% ownership, so he has to pay $1 million. So you can see that when the firm is using debt, cost is 100% imposed on Ross. So this basically means Ross will use less perk, Ross will use fewer perks, and Ross will engage in less wasteful behavior if the firm is using debt, right? So this is really simple math, right? So you can see that using equity will increase. So using equity will actually reduce manager's effort, and it will increase managers' excessive spending on perks. Okay, so you can see that that in this case has the benefit of preserving ownership concentration and reducing agency costs. Now, the second benefit is the second benefit is the reduction of wasteful investment. So why do managers want to make wasteful investment? Well, this is because of the so-called empire building hypothesis. So basically, the idea is managers, they will want to make investment to increase the firm's size, to make the firm larger, even if these investments are negative NPV projects. So why managers want to make their firms larger? Well, this is really because managers of larger firms, they will earn higher salaries, and then they will have better reputation, and they will have better, larger media exposure. They will have more publicity. They will be more famous. So due to these perks, due to these incentives, managers will want to build an empire. That is, by making their firm larger. And the second reason that managers will make wasteful investments is because overconfidence. So basically, you can imagine that if a manager is thinking about making an investment, then the basic approach is to calculate the NPV of the project. So let's say the manager overestimates her ability. Then what could happen is it's in fact a negative NPV project. But if the manager overestimates her ability to manage this project, then potentially when she is calculating its NPV, she will think, okay, this is a positive NPV project. So she would actually continue to pursue this project, even in fact it's a negative NPV project, right? So this will create wasteful investment. So why debt could be useful in reducing wasteful investment? Well, this is according to free cash flow hypothesis. It basically says that if firm have more if firm have more cash flows, have higher level of cash flow, then there is a higher probability that wasteful investment will happen. So you can see that the idea here is if we use debt, then if using debt can reduce free cash flow, then the probability of wasteful investment can be reduced. Okay, now why debt can reduce wasteful investment? Well, it's really because first, there are three reasons. First, it commits the firm to make future interest payments. And these interest payments will reduce cash flow. Second, because the firm is having debt, then there is this possibility of financial distress. These managers, they understand if they engage in too much wasteful investment, in the end, the firm might be in default or even declare bankruptcy. In this case, these managers could be fired. So you can see that simply due to the threat of financial distress, these managers, they will want to reduce wasteful investment if there is leverage. The third reason is because creditors, they can actually provide additional monitoring of managers. Basically what would happen is sometimes, let's say the firm is obtaining a large amount of debt from bank. Right? So if the bank lent money to a certain firm, then potentially the bank can have some representative to sit on the board of the firm as a director. So this director can actually monitor managers. So this director can prevent the manager from investing in negative NPV project. So this will reduce wasteful investment. Okay, so we basically have discussed 4 different kinds of costs and benefits of debt. And if we combine these 4 different kinds of benefits and costs, then we would have this trade-off theory. So basically, trade-off theory says firms will consider the trade-off between benefits and costs of debt and choose the level of debt optimally. If we include all these costs of benefits, then MM proposition 1 can actually be extended like this, right? Essentially, you can see that the first part is the value increase from interest tax shield. And we discussed this in the last chapter under both corporate taxes and personal taxes. Right? And then in this chapter, we discussed the cost of leverage, that is financial distress costs. And then from the agency perspective, we could have agency cost, that is asset substitution, debt overhand, and cashing out. And then we have this agency benefits. The main benefit is it will reduce the wasteful investment of managers. So you can see that we basically have 2 costs versus 2 benefits, right? So interest tax shield and agency benefits are about benefits. And then financial distress and agency costs are mainly about costs. This trade-off theory can be simply expressed in the following picture. So what you can see here is this. So what's the color? Orange. So this orange curve gives us the firm's levered value, and you can see that the optimal level of debt is given by D star. And you can see that the D star is obtained by understanding different kinds of benefits versus different kinds of costs. For example, if the firm is using too much leverage, there is this excess interest. Right? So we discussed this. That is, you don't want interest payment to be larger than EBIT. Right? If interest payment is larger than EBIT, we will have excess leverage. And then we understand because of the difference in personal taxes in equity income and interest income, having excess leverage will in the end generate this tax disadvantage of debt, which will reduce the firm's value. And then obviously we discussed this financial distress cost. That is, if you're using too much debt, then the firm would have higher probability of default. And if default cannot be solved, in the end, the firm will have to declare bankruptcy. So there will be this severe bankruptcy costs. Now we would have this excess risk taking, right? So this is the agency cost of debt. So basically, shareholders will engage in risky behavior. They would invest in negative NPV project, which reduces firm's value and harm debt holders. And then there could also be underinvestment. That is, this debt overhand problem, right? So if the firm has large amount of debt, there is this possibility of default, then even a positive NPV project will increase the firm's value. Shareholders will not want to pursue it. So this will, in the end, forego these positive NPV project, which ultimately reduce firm's value. However, you can see that there is also the cost from too little leverage. Right? So there is this first lost tax benefit. This basically refers to the fact that if you're having proper leverage, then you could enjoy this interest tax shield, which will increase the firm's value. And then there is this excessive perks. So this is about the agency benefits of debt. Right? We know that if you use the proper amount of debt, then debt will help preserve the concentration of ownership. It will reduce the consumption of perks. Obviously, this implies if the amount of debt is too low, then there will be excessive consumption of perks. And then wasteful investment, right? This is because if there is too little debt, then the firm would have abundant free cash flows. In this case, with a lot of money in their pockets, managers, they can engage in wasteful investment. Why do they want to do this wasteful investment? Well, because they have this empire building preference. Right? Okay, now let's look at this simple example. So Maple Leaf is considering adding leverage to its capital structure. And we assume its managers believe they can add as much as $35 million in debt and to get the benefits of the tax shield. So we assume the tax advantage of debt is given by 15%. And then they understand the higher debt level would increase the risk of financial distress. So based on the simulation of the firm's future cash flows, the CFO has made the following estimates. And what is the optimal debt choice for Maple Leaf? So what we would do is we will compare benefit versus cost, right? So by comparing benefit and cost, we can find out what's the net benefit. So for example, here the net benefit is 1.5. This net benefit here is 3 minus 0.38, which is 2.62. So this would be 2.13.5. This would be, so in the last case, right, with a high level of debt, you can see that the net benefit is actually negative. So it's minus, I don't know how, minus 0.87. So what you can see here is, if you draw a picture like this, so this is the benefit from debt, right? So this is the level of debt. What you can see here is at the amount of 20, right, we get the highest net benefit or total benefit. And when debt increases from a low level, then as debt increases, the benefit of debt increases, right? So we go from 0 to 1.5 to 2.62. And after this optimal level, then if you continue to increase your debt, then the benefit would actually decrease, right? So you can see that we go from 2.62 to 2.13, 2.5, and then we would actually get a negative number here. So this is really the curve similar to this, right? So we get this concave curve. Okay. So the trade-off theory would help us to explain why some firms they choose debt levels that are too low to exploit the interest tax shield, and why differences in the use of leverage across industries and firms. So obviously here we are still talking about the observation we have made in the last chapter. So let me remind you the observation we have made in chapter 7. So if you recall, right, we tried to understand the real world by looking at data obtained from the real world. So we find out first, the ratio of interest expense to EBIT for Canadian firms is always less than 35%. It seems that this number is too low, right? Because we know that to fully exploit the benefit of debt, we have to make sure interest payment is sort of close to EBIT. And then we also have this other observations. So for example, in this picture, we find out different industries, they have very different leverage ratios, right? For technology, it's very low. For financials and utilities, these two industries have quite high debt value ratio, right? Close to 50%. So the question here is, how could we use trade-off theory to explain these two observations? So first, we want to explain why some firms, such as firms with high-tech firms or young firms, why do they have low level of debt? So the first reason is these tech firms, they have low free cash flows. So basically they have a lot of growth potentials. So their cash flows are almost all used to make new investments. So they have low free cash flows. This basically means they don't need debt to provide a tax shield or control wasteful investment, right? So the first statement, provide a tax shield, refers to the benefit from the interest tax shield. We know that you will benefit from an interest tax shield only if you have taxable income. However, if the firm has low free cash flows, then its taxable earnings will be very small. So using debt will not generate tax shield. The second, control wasteful investment, comes from the agency benefit of debt. In there, we learned this free cash flow hypothesis, right? It says if the firm has abundant free cash flows, then managers will use these free cash flows to engage in wasteful investment. So here, if these firms they have low free cash flows, then there is little need to control wasteful investment. The second reason is this firm they have high human capital, so there would be large financial distress cost. The idea here is for these young firms or high-tech firms, the majority of their workforce is like engineers, scientists. And for these people, if the firm is in financial distress, this firm could just quit their job and move to a different firm. So in this case, you can see that the loss of human capital due to financial distress would be large. So these high-tech or young firms, they will not want to suffer from this. So they won't want to take a lot of debt. And then the third reason is from the perspective of the agency costs of debt. So basically, you can see that these young firms, high-tech firms, they have a lot of investment opportunities. So if they use debt, then there is higher likelihood this firm can invest in these risky negative project when there is this possibility of default, right? So basically the potential of asset substitution is high for high-tech and young firms. So to prevent asset substitution from happening, these firms should use low level of debt. Now, we could also see that mature low growth firms such as utility firms, right, such as Manitoba Hydro, these type of firms, they have stable cash flows and they have a lot of fixed assets. And these firms generally have a lot of debt. So why? Well, the reason is because these firms, they have high free cash flows. The reason is because essentially utility firms are boring firms. They don't have a lot of growth potentials and they don't have a lot of investment projects. So this basically means, according to free cash flow hypothesis, in these firms, the potential for wasteful investment is actually pretty high. So we need debt to reduce the potential of wasteful investments. So from the free cash flow hypothesis perspective, these firms, they would have high level of debt. And then the second reason is these firms, they have a lot of tangible asset. This implies for these firms, the possibility of financial distress is actually lower, and financial distress cost will also be lower. The reason is if the firm has any difficulty in repaying its debt, if this is a mature firm with a lot of fixed asset, then this firm can just liquidate these fixed assets to pay back its debt. Then it could avoid bankruptcy, avoid default, right? So this basically means, in some sense, these tangible assets could serve as collateral for these firms to get a high load of debt. Okay, now let's talk about the second type of theory. So the first type of theory is this trade-off theory, right? That is, firms would compare the different costs and benefits to think about the optimal level of debt. Now, the second type of theory is this pecking order hypothesis. So pecking order hypothesis basically says there is an order in terms of how managers want to finance their investment. To be more specific, managers will want to fund their investment by first using retained earnings, and then they will use debt. And managers will only use equity to finance their investments as a last resort. So this is basically the result, right? Or what is this pecking order hypothesis is about? The trade-off theory is based on the cost-benefit analysis. The pecking order theory, the pecking order hypothesis, is based on asymmetric information. So these two different theories have different origins or foundations. So let's first understand what is asymmetric information. So asymmetric information refers to, well, judging from the name, right? Information is asymmetric. It basically means there are two parties, and one party has more information than the other party. In economics, asymmetric information is like everywhere. You can think about, so in this class, you can imagine that generally managers have more information about the firm than shareholders, right? Because managers, they are managing the firm like every day. So they know potential investment opportunities, and they also understand the challenges of the firm. At least they know better than shareholders. So you can see that between managers and shareholders, there is asymmetric information. So here we will want to understand how this asymmetric information will actually motivate managers to change a firm's capital structure. So the first theory we will learn is leverage as a signal. So in economics, this is called signaling theory. Okay, now let's see this example here. So let's assume a CEO believes, okay, this is a typo, it's not believes, so believes. So assume a CEO believes his investment will be profitable, but investors are in doubt. Now, how the CEO can convince investors, right? Well, the firm can actually use debt as a signal to signal to these investors that indeed this investment is a good investment. Why? Well, let's see this. If the investment is actually a good investment, the firm will have no trouble to pay back the debt. And if the CEO is lying, that is, the investment is a bad investment, then in this case, the firm will have trouble to pay back its debt. and potentially the firm will be in default or file for bankruptcy. So the CEO will get lower wage or even get fired. And investors understand this. So basically they understand if the CEO is lying and if he is using large amount of debt, then there will be bad consequences for this CEO. This basically implies that after watching the firm is using a large amount of debt, investors can conjecture that this CEO is not lying. Right? So that's why this is called signal. So basically that signals to shareholders this project is a good project. So this is called signaling theory of debt. It means the use of leverage would signal good information to investors. So basically a firm can use debt to convince investors that its project is indeed good, even it cannot provide verifiable information about this project. So let's see this example here. Suppose that Beltran currently uses all equity financing, and Beltran's market value in 1 year will be $100 million or $50 million, depending on the success of this new strategy. So now investors consider the outcomes as equally likely. But this firm has information that the success is actually virtually certain. Now we have two questions. Will a leverage of $25 million make the firm's claims credible? How about a leverage of $55 million? Okay, now let's first write down these data. So the project value would be either $100 million or $50 million with a probability of 50% and 50%. This is from the investor's perspective. So this is investor's view. However, from the perspective of the firm, this is for certain, right? Now, the firm tries to use debt as a signal to signal this good information to investors. And the firm has two choices, $25 million and $55 million. Now let's see what happens if the firm is using this lower level of debt. Now, if the firm is using lower level of debt, what you can see here is if the project is success, then firm's value would be $95 million. Sorry. If the project is a success, after paying back this debt, equity holders will get $75 million. And in a second case, if the project is a failure, equity holders will get $25 million. Now, under both cases, the firm will not file for bankruptcy, right? Because they can pay back this debt. That is, under these two cases, the value of the firm will be larger than the level of debt. So there is no bankruptcy. And CEOs will stay as the CEO, and then there is no bankruptcy cost. The CEO will not get fired. And what about $55 million? If the firm is using $55 million, then what you can see here is, in the second case, if this is a bad project, the firm will be in default, right, or bankruptcy, because the firm's value is actually smaller than the amount of debt. So let's say the firm indeed uses $55 million. The investors will understand that this is the correct case, and the second case will not happen, because from manager's perspective, if this is a bad project, they will never want to borrow $55 million, because this will result in a default and they will get fired. So after seeing the debt level of $55 million, investor will understand this is the true result. This is the correct result. That is, this is a good project, and the firm's value will be for certain worth $100 million. Right? So the answer to this question is this higher level of debt will correctly signal to investors the success is virtually certain. The firm will be virtually worth $100 million after this project. Okay, now let's talk about adverse selection. So the second type of theory is about is using this adverse selection to explain why equity is underpriced. So let's first start with a real life example. So let's talk about a used car market. We will use this example to understand adverse selection. This is a really important concept in economics, and if you learn more advanced microeconomics, then you will definitely learn about this. So let's say there are two kinds of used cars in the market. So we have two kinds of cars, and 50% of them is bad cars. So their value would be just $2,000, and the other half would be better cars. So their value would be $4,000. And the two values will happen with equal probability. Now, this used car market has asymmetric information. So you can imagine that in a used car market, sellers will understand their car's actual value, right? This is true in real life. Only seller would understand whether this car has actually some mechanic problem or whether the car has been in an accident. Right? And from buyer's perspective, they don't really know whether a specific car is worth $4,000 or $2,000. The best that they can do is to calculate the average, right? So buyers will just put an average value on a car in the market. What is the average here? Well, it's obviously 4,000 times 50% plus 2,000 times 50%. So buyer, right? Buyer's value would be just $3,000. Now think about this. If buyers will only want to pay $3,000 for a used car, then a seller with a car whose value is $4,000 will never want to sell this car in the market, right? This implies that the 4,000 cars will altogether disappear from the market. And then buyers will understand this, right? So buyers will revise their estimation. So 3,000 will drop to $2,000 because buyers understand, hey, if I give this seller $3,000, then this seller cannot sell a car of $40,000 to me. So if I pay $3,000, I would definitely get a car whose worth is only $2,000, right? So in this case, why should I pay $3,000? I should definitely only pay $2,000. So you can see what's the end result. So in the end, only $2,000 cars will be in the market. And the equilibrium will be like this, right? Sellers will only sell $2,000 cars. Buyers will pay $2,000 to a used car. So this is called adverse selection. It happens when sellers have more information than buyers. Why this is called adverse selection? Because it basically means bad cars will be selected in the market. So you can see that in this used car market, cars sold in the market will be worse than average, right? Only $2,000 cars will be sold, and the average is actually $3,000. And you can imagine that this type of adverse selection will happen whenever sellers have more information than buyers. And you can imagine this will happen in this corporate finance context. That is, when the firm is selling equity to investors, managers, they have more information than investors. So in the end, this adverse selection problem will actually emerge in the equity market, right? So in the equity market, adverse selection will emerge, and we will again get this similar result. Okay, now let's talk about Lemon's principle. When a seller has more information about the value of a product, buyers will discount the price they are willing to pay due to adverse selection, right? So in the used car market, sellers has more information about the value of the used car. So you can see that in the end, buyers will not pay $3,000, this average price. They will only pay $2,000. Again, this Lemon's principle will also apply to this equity market, or this equity or this selling equity market. That is, whenever firm is trying to sell equity to investors, investors will not want to pay the average price. They will want to pay this lower price due to this adverse selection, right? So we will continue to discuss this, and we will apply this adverse selection and Lemon's principle in the market of equity and understand why equity is underpriced because of adverse selection. Okay, so today I will end this class.